We were recently approached by an established and well-managed construction company that was experiencing considerable cash flow problems. Now, these cash flow problems were causing the directors lots of worry, sleepless nights, and taking them away from doing what they do best, which was running a business on a day-to-day basis. The problems that they were experiencing were down to a number of reasons. First and foremost, the contracts that they'd entered into with their clients meant that payment terms were in place of anything between 45 days and 120 days. Now, that's going to cause any business some kind of cash flow issue. In addition, over the last 2 years, the company had taken out short-term and medium-term unsecured business loans and asset finance deals that were really expensive, and they were causing problems with cash flow. Now, the immediate concern that the directors had was that they were not going to make payroll at the end of the month, and they were concerned about defaulting on either the unsecured business loans or on the asset finance agreements. And if they did default, the problems that could cause the company going forward. So we sat down with the clients to really get a feel for what they wanted to achieve. And what came out of the discussions was that they wanted us to restructure the unsecured loans and the asset finance deals. So we agreed to take a look at the asset finance deals and unsecured business loans that they had in place, and we worked the figures. Now, if we'd restructured these loans and asset finance deals, yes, we could have raised some additional funds, but all we were doing is kicking the problem down the road. And we forecast that within about 75 days, the clients would be in the same position again, in that they'd have cash flow problems. The biggest problem we had was that money was tied up within invoices that were getting paid on anything between 45 days and 120 days. And that was the major problem here. So we sat down with the clients and went through the options. We talked about refinancing existing debt and the problems that were associated with it. And the clients agreed that that wasn't the best way forward. We then broached the subject of invoice finance. And the clients were hesitant at first because they'd heard lots of bad things about invoice finance, often referred to as factoring. They'd worked with people and clients who had factoring agreements in place and heard some real horror stories. But when we started to dig a little bit deeper, we found out that these were conversations that had taken place 10 years ago, when, in fairness, invoice financing and factoring, it was a little bit like the Wild West. And the client's understanding of invoice finance and factoring was really, really limited. So we sat down, we talked to them, and we explained to them how invoice financing works, and that if they raised an invoice within 24 hours, the finance company who was sitting behind that invoice would release up to 80% of that invoice for them, and that would help their cash flow. And we also worked through the numbers with them to show them how much that would cost them to release money from those invoices. And the clients were quite surprised, and it wasn't as expensive as they thought it would be. So it was a really, really constructive discussion that we had with the clients. We got to the point where the client said, okay, let's move this forward. And they wanted to have a chat with some invoice finance providers. Now, because they worked in the construction sector, the number of invoice finance providers you could actually work with were really limited. So we brought one invoice finance provider to the table, and the clients had a really, really good meeting with them. And I suppose the upshot here is the clients had an invoice finance facility in place within 3 weeks of meeting the lender. It's taken away all the pressure that was on them with cash flow, because they're now raising the invoices and being able to release up to 80% of those invoices and getting that money into their cash flow. So that's made a really big difference to the company. In addition, we did go back and restructure their short-term business loans and their asset finance deals. We didn't raise any additional funds on top of that just because it wasn't the right thing to do. And we've got a responsibility to our clients to act properly and not just be looking to raise additional funds for them. So we restructured those deals, and that in itself is saving the clients close to £1,000 a month. So, although invoice finance can be considered to be scary and worrying. In the right circumstances and for the right companies, it's often the best thing to do, rather than looking at short-term business loans, which, let's face it, can sometimes just be putting a sticky plaster over a cut when major surgery is needed. So, yeah, it's worth considering invoice finance if you're struggling with cash flow. There's lots of things that need to be taken into account, and any good broker will talk you through the pros and cons of invoice finance. But yeah, worth considering.